Breaking news, gold and silver are ripping to fresh record highs, and it's not because the economy suddenly got healthier, it's because markets smell political risk. A tariff threat aimed at U.S. allies is triggering a full-blown flight to safety, and investors are piling into precious metals like the fire alarm just went off. So here's the question. When Washington uses tariffs as a geopolitical weapon, are we protecting American strength or exporting chaos and importing higher prices? Tonight we cover three things. First, the hard numbers. Exactly how high gold and silver jump and what the market is pricing in right now. Second, the mechanics. Why tariff threats push metals higher, weaken the dollar, and shake equities all at once. Third, the real-world fallout. What this means for American families, small businesses, and the credibility of U.S. economic policy. But here's the kicker. This spike is a warning signal, not a victory lap. Here's what just happened. On Jan 19, gold and silver hit record highs as investors rush into safe haven assets after President Donald Trump warned of extra tariffs on several European countries connected to the Greenland dispute. Reuters reports spot gold surges as high as $4,689.39 per ounce, and spot silver touches $94.10 per ounce, both all-time highs. By 10:08 a.m. ET, 15:08 GMT, Reuters says spot gold is still up around 1.6% at $4,169.69, while U.S. gold futures for February delivery rise 1.7% to 4,275. Silver, meanwhile, is up about 4.4% near 93.93 after that peak. And it gets worse. This isn't just about metals. Reuters also reports global stocks drop and the dollar eases as the tariff threat accelerates a risk-off move. Money fleeing stocks and rushing into havens like gold, the Japanese yen, and the Swiss franc. Now for the human side, picture a middle-class family that finally feels like inflation is cooling. They're budgeting carefully, gas, groceries, the car payment, the mortgage. Then a tariff shock hits markets. Companies raise import-linked prices, and stable turns into uncertain overnight. That's what safe haven rallies really mean. Investors aren't celebrating, they're bracing. So when gold hits a record, it's not a patriotic scoreboard. It's a stress meter, and that stress meter is flashing red. Let's unpack the mechanism, because this isn't magic, it's market physics. When a president threatens tariffs, markets don't wait for the paperwork. Traders immediately price in three things: higher inflation risk, slower growth risk, and retaliation risk. That combination is toxic for equities and powerful fuel for precious metals. Start with the tariff timeline. Reuters reports Trump says he would impose additional 10% levies from February 1st on goods imported from Denmark, Norway, Sweden, France, Germany, the Netherlands, Finland, and Britain, rising to 25% on June 1st if no deal is reached. Those dates matter because markets hate deadlines, especially politically driven ones. So what happens next? 1. Stocks wobble. Reuters notes S&P 500 and NASDAQ futures drop over 1.2%, while Europe's StoxX 600 falls 1.2%. This is the market saying, we don't know how bad this gets, so we reduce risk. 2. 3. The dollar weakens. Reuters highlights something unusual. Typically, the dollar strengthens during geopolitical stress, but here it weakens because the uncertainty originates from the U.S. itself. That pushes some investors to diversify away from U.S. assets. 4. 5. Gold benefits twice. Gold often rises when uncertainty increases, and it often rises when the dollar falls, because gold is priced in dollars. So a tariff threat that dents the dollar and raises fear is like a double boost. 6. Reuters also adds the interest rate channel. Fed Vice Chair for Supervision Michelle Bowman says a fragile job market means the Fed should be ready to cut rates again if needed. Reuters reports markets expect the Fed to hold at the Jan 27-28 meeting, but price in at least 2 cuts of 25 basis points this year. Lower rate expectations reduce the opportunity cost of holding gold. Now here's the kicker. Silver isn't just a fear metal, It's also an industrial input, and it can react violently when traders see both inflation risk and monetary easing ahead. Reuters reports silver is up more than 31% since the start of the year. That's not a gentle climb. That's a market sprint. Historical precedent? The tariff era of the late 2010s taught markets a brutal lesson. Even targeted tariffs can spill into broad supply chain disruption, business uncertainty, and retaliatory measures. The key takeaway from that period, according to many analysts, was that uncertainty itself can be as damaging as the tariff rate. Here's an analogy. Tariffs work like throwing sand into the gears of a global machine. You might slow one part down on purpose. But the machine doesn't politely slow only where you want. It grinds, overheats, and breaks parts you didn't even know were connected. And that is why gold at a record high is less a trade and more a diagnosis. Now let's talk about who actually gets hit, because market charts don't pay the bills. American workers and families. Example 1, higher consumer prices. If tariffs hit imports from major European economies, companies pass costs forward. That's not ideology, that's accounting. Example 2, job uncertainty. If firms expect a tariff fight to escalate from 10% on February 1 to 25% on June 1st, they freeze hiring and delay expansion. That creates quiet layoffs, reduced overtime, and weaker wage growth. Example 3, retirement savings volatility. Reuters reports stock declines tied to the tariff threat. Futures down, Europe down. For a 55-year-old planning retirement, volatility isn't market drama, it's anxiety. So ask yourself, if the goal is national leverage, why are American households absorbing the turbulence? Consider a U.S. specialty manufacturer, maybe medical devices or precision tools that relies on German components. A 10% tariff hits immediately. A 25% tariff threatens to crush margins entirely. They can't redesign a supply chain in weeks. They either raise prices and lose customers or cut payroll to survive. And it gets worse because their bank sees risk too. When uncertainty rises, lenders tighten terms. Suddenly, the small business can't finance inventory at the same rates. That's how a policy threat becomes a Main Street cash squeeze. Big firms are exposed in a different way: global revenue and global supply chains. Reuters notes the risk-off move hits broad markets. CNBC reports Europe's autos and luxury sectors slide on tariff fears, with the Stoxx Europe 600 Autos and Parts Index down 2.2% and the luxury index down 2.9% in early dealing. Large corporations react fast. They hedge currencies, adjust pricing, shift inventory, but those moves cost money and consumers ultimately see it. Reuters reports European leaders condemn the tariff threats as blackmail, and France proposes responding with previously untested countermeasures. This is not a routine trade spat. It's a geopolitical confrontation that can spread into services, investments, and beyond. Experts' warnings and predictions. One camp of analysts warns the tariff threat sets up a classic tit-for-tat cycle that lifts inflation and slows growth. Another warns the dollar's safe haven role weakens when the shock originates in U.S. policy, increasing borrowing costs over time. And precious metals analysts are already making aggressive near-term targets. Citi Research sets targets of $5,000 gold and $100 silver in the next 3 months, citing elevated geopolitical tensions. A gold rally is not just a trade, it's a referendum on stability. Let's put the expert commentary into context, because we're watching a credibility test. Reuters quotes Lin Tran saying markets reallocate swiftly towards safe haven assets when institutional and policy risks return. That line matters because it's not blaming speculators. It's describing rational defensive behavior. Reuters also quotes George Ligarius, chief economist at Forvis Mazars, saying markets are reacting to new tariff threats, adding it's highly likely the White House uses the threat of tariffs consistently, even when deals already exist. That's a direct warning about uncertainty becoming permanent. And then there's the forward-looking forecast. Citi Research remains tactically bullish and targets $5,000 gold and $100 silver within 3 months. Whether those targets hit or not, the fact that they're being discussed tells you how stressed the macro environment is. So what are the implications? Legally and economically, tariffs at this scale invite retaliation. Reuters notes the EU has options, including a suspended package of tariffs on 93 billion euros, 108 billion of US goods, and potential use of the anti-coercion instrument that could hit services, trade, or investments. That raises the stakes far beyond imports at the border. Short-term effects, next 30-90 days. Markets fixate on the February 1 tariff start date. Companies accelerate inventory and hedging. Diplomatic escalation dominates Davos and other forums, increasing volatility. Medium-term scenario, 6 to 12 months. If tariffs rise toward 25% and retaliation lands, we enter a high-price, low-trust environment. Inflation pressure persists, corporate investment slows, and safe haven assets stay elevated, meaning gold remains strong, not because the economy is booming, but because confidence is cracking. And here's the question: what does it say about economic governance when gold becomes the asset of the moment? Let's recap the 3 most critical points. First, gold and silver hit record highs: $4,689.39 for spot gold and $94.10 for spot silver, after tariff threats reignite a safety rush. Second, the tariff schedule, 10% from February 1, rising to 25% from June 1st, creates uncertainty that hits stocks, weakens the dollar, and drives investors into havens. Third, the fallout lands on families, small businesses, and global trade credibility, while analysts float extreme upside targets like $5,000 gold and $100 silver in 3 months. So tell me, is this strategy or economic self-sabotage? If you want to stay informed on stories the mainstream media won't fully cover, make sure you're subscribed and hit the bell icon. When gold screams record high, it's the market whispering, "We don't trust what comes next." Thank you for watching, and I'll see you in the next one.